and it is time now to talk business with our partners 2 Degrees. Did you know our banks could be carrying $1 billion worth of mortgages over homes that are at risk of being swept away in a flood? Garth Bray from Business Desk has the alarming stat this morning. Garth, good morning.
Yeah, that's a bit of a shocker, isn't it, Ryan? And this has come out of, you were talking about Griffith University, some research from Griffith and Otago and Earth Sciences New Zealand, who've been taking a look at this problem with some data from NIWA, Cotality and other places. And they have pinned this down to about 6,500 homes across the lending books of our 5 major banks, and say that this is basically underappreciated risk of that asset being swept away either in a flood or by sea level rise. Obviously one is sudden, the other is gradual and easier to spot. And I mean, just to put it in context, I mean, that's $996 million worth of homes, but there's about $380 billion worth of lending.
It's a drop in the ocean.
Maybe not so good for the people who, I mean, obviously a worry for the people whose homes those are, but for the banks and for the banking sector and for our ability to have confidence in it, what's the risk there? The numbers suggest that it puts a bit of a dent in some of the capital adequacy that the banks have, but not enough to completely erode it to the point where the Reserve Bank needs to be panicking. So it's a nudge, but it's a warning to them really that they need to take a closer look, because the 1 in 100 year flooding events and the risk of rivers bursting their banks and so on hasn't quite been worked out in this one. And so they're saying there could be a higher risk. Now, interesting, some of the experts that are looking at this said, well, could this be a problem if you've got, say, Kiwibank coming on stream wanting to aggressively lend more? Are they going to be picking up basically the riskier assets out there as bigger banks dump them?
Interesting.
And Kiwibank saying, no, we're across this, we know about our risk and so on, we're taking a close look at all this sort of stuff, and we're looking at climate adaptation, will hopefully to sort of work that through.
The other thing I was reading about on Friday, the select committee that's recommended, is urging the Reserve Bank to revisit its how much capital it has to hold. But the farmers in particular are pushing for this, right?
Yeah, right. Well, this came out of the, basically it was an NZ First proposal, I think, to take a look at rural lending, or woke lending as they were calling it. They thought that a whole bunch of green lending measures were pushing up the effective price of other kinds of rural lending. No sort of firm conclusions about that, although I think the committee basically said, yeah, we do want the Reserve Bank to develop some transparent national guidelines for banks on how they apply climate-related risk and so on, back to that earlier thing. But they were also saying, look, straight away you need to look again at the capital adequacy ratios. This is, as you say, the amount of money that major banks have to hold in reserve when they're lending, and they say, well, the higher that number is, the less lending we can actually do if we've got to keep a certain portion aside. I think that it started at about 10.5% of whatever the lending book was when this thing first came in 2021. It's been bumped up from 13.5% to 14.5% this year, and it's supposed to hit 18% over the next couple of years, just to sort of ensure that there's enough fat in the system. Right? They're saying, well, that next jump, forget about it. That'll make it easier and cheaper for banks to lend. It could obviously help the bottom lines of those 4 big banks. There's some concerns about whether it'll really help the smaller ones, because those bigger ones, if they're more competitive, might drown it out.
But the idea is that you make the system safer. So that it should everything go tits up. A bank falls over, we're not the taxpayer left picking up the tab.
But the point is that they're now consulting. Apparently they've got some callings to the press in today for a bit of a chat about how the Reserve Bank's going to put out some consultation on this to say, yes, we might look at abandoning that next level. Too high on the old next bit of insurance.
Take it down a notch. Retail, what's going on?
Well, about mid-morning we're expecting the Q2 retail sales data to come out. It'll probably be pretty soft because we know the economy hasn't been great. We know that card spending has been down. But what we're also seeing is a lot of gross margin pressure, on the retailers. That's the gap between what they bought it for from China or wherever and what they're actually ultimately able to sell it to. And it's down about 140 basis points in some, which is quite significant for some retailers. So in other words, good time to go shopping if you can afford it, basically. And they'll be trying to push some of those sales through because they're heading into reporting results in the next month or so. So try and make the books look good. So your warehouse, I think they cut about 8% off 1,300 lines earlier this year to try and hang on to their market share. They're all going to be out there pushing for your dollar.
All of that means, as you say, their margin's getting a bit squeezed too. Garth, good to see you. Garth Bray, Business Desk. Thanks to our partners 2 Degrees this morning.